Mortgage rates rising again this week, reaching a 2-month high and flirting with 7% yet again. And it comes as pending home sales fell nearly 5% in January. Let's welcome in Sheryl Palmer, Taylor Morrison CEO. Sheryl, it's good to see you.
Well, good to see you.
I want to start with the 30-year fixed, Sheryl. Let's take a look at that. So we're not at 8% like we were in October, so that's nice. But according to Mortgage News Daily, we are at 7.1%. What does that mean, Sheryl, just for the housing market and home builders?
Yeah, it's been volatile for a while now, right? Mm-hmm. Like you said, we were at 8% in the fall, then we were at 6.5%, now we're at 7%, just over 7%, I think, at par. I think the consumer's getting a little bit more, I think, recognizing that we're seeing this kind of volatility. What does it mean? The consumers have come a long way in the last year, 18 months, when rates were flirting at that 7%. But the difference from where we are today to where we were then is back then they were still hoping rates were going to go back to 4%. And I think the consumer has met us kind of in the middle, recognizing that rates in the 5s or 6s is actually, from any kind of long-term historic perspective, a really good rate. So, what we are able to do in the new home market is really help our customers understand the different programs that are available to them. So we're able to go into the market, buy what we would call a forward commitment, have that available. So a customer walks in, and even though they could go to the bank and get a 7.25 rate, we can offer them like a 5.49. Maybe FHA, it's 4.99. The reality is every buyer needs something a little bit different. Some need help with cash to close. Some want the confidence of a 30-year fix. Some need, maybe the next couple of years they want a lower rate, so it's a temporary buy down. So really the ability to personalize it today, I think, is most important. But I think it's created a real advantage for the new home market versus that opportunity doesn't really exist in the existing market.
Well, and all of that by another name would be incentives, right? You're offering incentives to these home builders. Right. But I am curious, as rates hopefully at some point start to move down, do you all get to pull back? When do you get to pull back on those incentives, which presumably would be better for your bottom line?
For sure. I think, honestly, we already have, because if you go back to that point in time when, let's say, rates were 7 a year ago and the consumer wanted something around 4 and we were offering like 4.49, that seemed to be the magic number. The cost of doing that was more expensive than when they're in 7s trying to get to a mid-5. The average rate that we're closing consumers with in the fourth quarter was actually 6.7. So the consumer, when I said they've met us halfway, they've met us more than halfway. If I went back to third quarter, I think that was 6.5. Now that's the final takeout coupon rate. So maybe they've got a rate, and that's our average across everything we closed. So maybe they have a rate that is, 4.7, 5.7, and then their final rate is 6.7. But those are different ways we can, utilize to bring the cost down. And once again, I think the customer recognizes rates in the 5s and 6s is really good.
Yeah. Sure. I'm curious, what your kind of inventory looks like right now, just across the production cycle. A new home,
it's pretty low.
Finished.
Yeah, and it's a really important point because we've actually seen a slight rise in total inventory in the new home market. I think we're almost to about 8 months of inventory. The real key statistic is we only have 1.4 months of finished inventory. So you need some finished inventory. Some people, are moving, they come into a new market, they need a house. Some are coming out of an apartment. So actually, by all standards, it's almost a little too low. So inventory's good. I always say to our team, inventory's good. You just want to sell it while it's in progress and not have a lot of finished inventory. And that's kind of where we are. So if you look at the new home inventory at about 1.4 months of finished, and you look at the resale market at around 3 months, just moved up to about 3 months, that's still really low. So in total, we're really undersupplied.
Yeah, I mean, that's how it feels. Certainly that's how it feels on the existing homes market side as well. Just real quickly here, where's the tipping point in this housing market in terms of where we are going to start to see more of a dramatic reacceleration in sales? Is there a magic number for mortgage rates, for example, for the 30-year fixed?
Yeah, it's a really good question. I don't know if it's as much about the rate, one person's opinion, as just the signaling that this volatility is behind us. Because I think two things can happen here. One, when you think about rates, we're in the 6's kind of at the end of the year, we did see an acceleration. We actually, since rates have moved to 7, because of all those tools, we actually haven't, as I said on our earnings call, we came into the first of the year with a pretty strong January and early February. So the spread today between the 10 and the 30 is equally as difficult, or I think sticky for us, as it is whatever the Fed does. Because I think when the Fed kind of signals we're ready, I mean, he's kind of done it, right? But not fully. There's a little bit of mixed messaging still there. Then I think you start to see a reduction in that spread. Then, if it's summer, if it's fall, everyone has a different view on when that happens. I think that means we know we're not going to have this volatility. There's great demand out there. So I think people pull off the sidelines. Nobody wants to have the highest rate.
Yeah, I know a few people who are in the market. Sheryl, thank you so much. I appreciate you being here.
Thank you, Sheryl.
Good to
Thanks
see
a
you.
lot.